So what we're going to do is that we're going to make this more of an interactive discussion. So what we want to do is obviously from the panel's perspective, they're going to provide, we have some Q&A that we've have prepared in advance. But when we look around the room and obviously from your respective experience, there's a lot that you can add. You may have some questions based on some of the things that we're saying. So rather than just wait to the very end of the presentation, we really want to have this dynamic. So if there's things that the presenters say that you have a perspective on, maybe you agree, maybe you don't agree, maybe you may agree sideways, we want to hear from you because that's the way that we grow and learn together. Otherwise, it's just going to be, this Q&A that can become somewhat monotonous, right? And we don't really want to have that. So we really want to look at the room, say, how can you provide input? How can we provide input from an exchange to really make this a dynamic discussion? So to start with, my name is Wayne Brown. I'm the managing partner of the Walker Group. We're a fintech boutique consulting company that's been around for about 17 years. We work with fintechs to help them scale, provide opportunities, revenue associated with fintechs. We have managed over 1,000 fintechs through incubators and accelerators in the last 15, 16 years. So I'm going to introduce the panel. They're going to provide a 30-second overview. We can keep that within 30 seconds, and then we'll have some questions. And then again, look to you as an audience for some more information to make this a dynamic discussion. Would you like to start?
Yeah. So I am an advisor to funds. I started investment banking, then I worked for Trust Company of the West, and then the same team we migrated and we invested for same team for 16 years. The money of 4 family offices that became like 10. We terminated this firm because I lost two of my partners in 2016. And then I went to work for a family office called Office Square. Basically what they wanted was, my network to get into later stage technology investment companies in the US. And I left that, and now I work with 3 funds. And the work that I do there is basically the same, help them to get into investments that I see in the market. I'm on the board and also advise like exits, and when we're fundraising, also part of the team.
And introduce yourself, please.
Pardon me?
Introduce yourself, your name.
Eveline Gerck, yeah.
Everybody knows. Okay, just want to make sure.
I just went too quick. Eveline Gerck.
Thank you, Chris.
Hi, I'm Chris Anci. Started my career, which now is getting to be quite, I used to say 20 plus years, and now it's a lot longer than that. Spent a bunch of years at Bankers Trust building 40 Act mutual funds for them. Then I spun out, ran my own broker dealer for about 17 years. And then after that, spent the last 8 years working for an ultra high net worth real estate family here in the city, in their family office that we helped started. Currently play both a role on the sell side of private equity, where we raise money for Series A, startups and et cetera, and then also on the buy side.
Okay, thank you. Taylor?
Mute.
You're on mute.
You're on mute.
Yes, thank you. Taylor West, I'm a partner at Marcum LLP. I lead our valuation practice for the firm, have about 150 valuation professionals that focus primarily on business valuation and asset valuation. So we can value anything from real estate to intangible assets, as well as businesses. We have a pretty broad practice valuing a lot of private equity investments, doing a lot of tax valuations for high net worth individuals, as well as corporate tax valuations, financial reporting valuations, and so forth. Happy to be here today. Thank you.
Great. Thank you. Samy?
Thank you. Good morning, everyone. My name's Samy Dwek. I'm a banker in recovery. I spent over 26 years in finance, 19 of them with JP Morgan. And yes, they will be coming after the last panelist. No, I'm joking. I spent a lot of time building out emerging markets, particularly in Israel, was part of Startup Nation 6 years ago, 5 years ago. I left JP Morgan. I set up a consulting family where I work with family offices, predominantly on communication issues, and I also help them review their investments and how they invest in elements like private equity and do their business transactions.
Okay, thank you. So let's start with our first question. And we've heard this question for a number on the panel, just kind of looking at the year of 2023, kind of think about what's your view with the state of the private equity venture capital space as far as this year is concerned, and then kind of think about what you think 2024 is going to look like. Chris, you want to take that?
Sure. I think 2023, you can call maybe a land of purgatory in the private equity space. Some of our some Series A's actually got filled, but if you look at it from a fund perspective, a lot of people went out to raise their funds, 150s, 250s, whatever, they all came up short. On private company raises, like I said, some A rounds did okay, but a lot of later stage Series C rounds either got shelved because they were going to be down rounds, or they just they actually did the down round and they came in. So I think that everybody kind of sat on their hands, adjusted to the new rate, cycle that everybody has to deal with. Also, I think a lot of family offices, I mean, there's a lot of money, trillions of dollars have poured into private equity. And I think a lot of people feel, Suzanne used the term gated before, they're kind of quasi-gated, right? Because everybody's in private equity for liquidity events. And now that cycle seems to be a little bit on hold. So I think some people are looking at their portfolio and realizing that they got a whole ton of non-marginable, non-lendable, private equity assets. So it's definitely jamming them up. Themes for 24. I mean, if it wasn't an election year, I think you could say that we were kind of off to the races again once the Fed, either, stops its counterfeiting ring or it continues its counterfeiting ring. I'm not really sure what it's going to do. But I do think that we'll see some bank mergers. I think that the crisis that started in March has been relatively glossed over, and nobody probably tracks what all these banks hitting the Fed's window, why they chose First Republic and Silicon Valley to go out and let everybody else borrow against the furniture, I don't really know. But I think that whole thing will be, somewhat mitigating itself in 24.
Mm-hmm. Yeah. Nice observation. Samy, you have a thought?
Yeah, so 23 has been an interesting year. It was more SVB, I think, than First Republic that kind of buckled the private equity market, in that a lot of funding went kind of skew-if, and startups started to struggle finding funding. I think family offices have been a lot more restrained in their investments, especially direct investments, more than private equity. Private equity has been desperately trying to raise money, and you're right, there's a lot of dry capital, but I think people are reticent to put their money down at the moment. Now, 24, irregardless of interest rates, which are normal, because we got used to low interest rates for too long that we forget this is normal. I think that there's going to be an interesting year, regardless of whoever comes into power. I think that we're going to go through some kind of mini recession, and people are looking for returns. And equity returns have been phenomenal this year. Private equity, I don't think, has been as good. So they need to prove themselves. I think companies are hurting. I think valuations on private companies are down. I think it's going to be an interesting time to actually start allocating capital to private equity.
Right. Taylor, you had an observation with regards to the valuation of companies and the impact of interest rates. You want to talk a little bit about that and the impact on private equity?
Sure. Yeah, I guess, early on when rates went way up, we saw a direct, immediate impact on cost of capital, rates of return that directly impacted valuations. And then, months later, you started to see the secondary impact on, just impact on the fundamental businesses, their performance, as well as, compounded with the cost of capital. And, we saw transaction volumes going down. As Samy indicated, we saw multiples moderate a bit this year. So that's what we saw pretty much through the third quarter of this year. And then actually our transaction advisory side of our business saw a pretty good comeback right toward the end of this year. So in the last couple months, we've seen a lot of activity on the M&A side, exit preparation. And I think, part of that is due to private equity firms, wanting to do something before year end. But what we're hearing is that there's a kind of a broader kind of acceptance of where interest rates are. The market is kind of settled in. The worries about continued increases have subsided, and people are actually talking about maybe decreases in the coming year. So because of that, and because of the need for the PE firms to put money to work, we believe those are really the primary drivers of a recent increase in activity. And the expectation is that we'll see an increase continue on into the new year, especially if, the economy continues to perform and inflation continues to trend the right way. And we see rates, obviously, if we see rates come off and cost of capital follow, we would expect that trend to get even better.
Good. Thank you. Eveline, do you have an observation with regards to how, from what you do and from your business perspective for 2023, and then what do you think 2024 is going to look like for the area of your focus?
Yeah, so when I started private equity, first day my boss told me, you're coming from banking, let me tell you something. You need to remember 3 words in private equity: exit, exit, exit. And I never forgot that. And that's why it was so successful and raised so many funds. And so we have 2 markets that when we talk about private equity, you have private equity, you have the lower middle market and the large buyouts, and then you have venture capital. So I started in the lower middle market. And when you look at the lower middle market and private equity, those companies, they're all in trouble, and the funds are all in trouble because the model was LBO. And then the interest rates went up, and then how we're going to adjust to the interest rates up. They kept going up, and a lot of those companies were going down, and they had to do mergers, and you have this merger environment, and then you have the private credit. So even, the investors that have the private equity funds, like BlackRock, now they have the private credit, and they're going to try to lend to the same companies so they can save the portfolio. So you have those things going on, besides what the other, panel talk about, the new private credit environment, right? And so exits in private equity are extremely hard to have right now, except for the Dell guy that was an incredible deal, right? But he was 10 years, whining and grinding that thing. So, and he had a number of value creation going on. So this is an exception. If you look at the traditional lower middle market funds, they're all, in trouble because they cannot exit. Okay, Marty wants me to move.
Oh, okay. Yeah, I told you.
No, I know. All
That
right,
was subtle.
boss. That was-
Jeez.
So when you go to venture capital, it's a little better environment because I am involved with 2 venture capital funds. One is later stage, the other one is early stage. The early stage one, we had 35 companies in the portfolio. We love to say none of the companies are going under. And then this year, 4 went down. So we're not immune anymore. But then we have the companies that we really like that became like unicorns. And we are holding to that. We didn't exit. And we all know it's public markets are going up. They did really well this year. I think next year they're going to do well. And we have the valuation expert here. He can talk about that. But at the end of the day, you look at comparisons, and you're going to look at, again, at the public markets. And I think you're going to be able, at least my funds, we're going to start exiting companies this year, because as you give money back, it's easier for you to raise a new fund. So as investors see, now this is happening. So I think that's a trend that if you have, companies in a portfolio that you can exit this year as valuations go up, they might not be like the best possible, just exit some. So we had a company in our portfolio that we invested was the value of the company was $5 million. And then the valuation until the market went down was 1.5 billion. And then, we had a meeting, said, I was very strong, we have to exit now. And then the CEO said, no, this company is going to be worth by 2025, $10 billion. So the point is, now next exit, so let's not exit now. Now it's not 1.5 billion anymore. But you keep in the books the less valuation, but the less raising, right? They're not saying now it's not less. But I think that this company is going to be worth more than 1.5 as this, again, as the markets recover. And that's what I think is the trend in the venture capital world is you need to have some exits because those funds are desperate to raise new funds. And that's the trend. And if you have companies in your portfolio, both private equity is more complicated, but in venture capital, you're seeing that you're trying to do a lot of M&As in that space too. So it's very active right now because you have a lot of little companies. The earlier that they are is more trouble to survive with this environment. So I see a very strong M&A environment this year and 2025, because that's the way for you to exit.
Excellent, yeah. Does anybody have any observation based on what the panel had mentioned? Do you agree with what they said? Do you have another thought, an observation? Yes.
Go ahead.
I saw you.
Just thank you. Quick question. You had commented about tons of money being thrown into PE, VC, et cetera. Where are you seeing, say, your family office, for example, or the ones with whom you interact? Where are you seeing them in the public markets, right? Markets are up this year in the US, also internationally. What are you seeing? Are they saying, oh, yeah, no privates, no VC, because we're waiting to see what happens? Because that's why there's an issue raising money. Are they reverting back saying, you know, while we're waiting, let's put in more.
So
of a
family offices are,
and international.
yeah, so family offices are kind of a different, everybody tries to lump them into one bucket, right? And they run the gamut, right? You could start with the ones all the way on the far left that are managing real estate, booking private airplanes and managing the kids during the summer and all this kind of stuff, all the way over to people that are just running philanthropic offices where they're just giving money away all day, right? And then you have the ones in the middle that are doing combination things. The one that was with, we were building a non-correlated hedge of private against a real estate portfolio, right? And kind of worked out because they're 100% commercial. So kind of, you know, some of our gains worked out and they're kind of scratching their heads like, you can make that kind of money doing this? It's like, yes, it's a little better than collecting rent, right? But I do think that as an asset class, right, private equity is not going away, right? I'm currently in conversations with a group. We're targeting RIAs. RIAs are still in, not MMT, but they're in MPT monoportfolio. They're still 60-40. They've gotten burned a little bit on that, even though equities did help them out a little bit this year. But they're all looking to move to an allocation of 5 to 10% across their books to private equity, right? Because that's what people are looking to correlate, because it's an identifiable asset class that people need now. Is what I would say, if I answered your question.
Thank you. Yes.
Well, just an observation. I think 2023 was a year that brought us back to reality. And after over a decade of zero money, would you defer P&L? You now have to focus on P&L right off the bat. So the companies that really are going to make it and we should be looking at are the ones that could produce the numbers, top and bottom line, or very, very soon, as opposed to deferring it. That is the reality with new rates. And so I think they're going back to the 90s and 2000, that kind of thinking. So I just wanted to make that observation. When you look at these things, you can say anything you want, mid-stage, that stage, whatever. If they're not P&L responsible, you right away, you're going to be deferring future a long time. So
there was an old saying, shirt sleeves to shirt sleeves in 3 generations, right? The grandfather made it, father ran it, and then the kids blew it, right? Well, everybody got like an extra generation and a half because the feds ran it down to 0, right? So now you've got the 4th generation, and God only knows what they're thinking, right? Running these companies or these old portfolios in a normalized interest rate environment, right? So the jury is still out. We'll see. And that also goes with private equity companies, right? Who have been running around sitting there. Everybody says it's 10x. What do you mean it's 10x? You have no, oh, I did $1 million in revenue. It's worth 10 times rev. It's like everything's 10 times rev, but the market is starting to look at what you said, which is P&L.
Yeah, so that 10x valuation was based on 1% or 0% interest rates in the marketplace too.
Right.
And was also, and
people are gonna buy your product if they can finance it at a cheap rate as well.
yeah, and it was also,
Right, so-
it's also tech, it's also kind of a tech valuation, because look, we all know, like, look, tech margins are tech, the first disc, to date myself, the first disc is the most expensive disc, right? Costs $400 million to make Call of Duty, and then the next
Right.
one's free all the way until they sell 2 billion of it.
Yeah, I'll take
But-
the 0 value.
But then when a consumer company comes in and they got the next canned alcoholic beverage that they're trying to sell us, right? And they think that it's 10x because they sold 14 cases, that gets a little thin, you know?
So I just have a
Yes,
couple
Mark.
of questions. So, my food for thought is that I think venture is in a problematic state right now because rates have gone up so much. And I think there's gonna be, as you said already, a merger wave. Just because that merger wave is gonna happen, I think a lot of companies are just gonna go to 0 valuation, not be acquired, right? there's gonna be this merger wave, right? I think, after that, it's gonna be about, can VC survive in a 7% interest rate environment? Where instead of having Silicon Valley Bank providing you lines of credit at prime +1, can you survive on, lines of credit at prime +15 or prime +8 plus warrants, right? So I mean, I think the venture's in for a long haul of challenges.
Yeah.
So Martin, if I can just interject here, Samy here, sorry.
Yeah.
I don't know if it's about interest rates. I think, and someone mentioned it before Chris spoke, I couldn't see him, he was off camera, but we had this, and I'm going to use an old term, irrational exuberance in terms of the valuations of a lot of tech companies that were just overblown and stupid. And so people were investing at ridiculous rates, and now all of a sudden they're seeing these massive markdowns on their portfolio, and a lot of these companies are being wiped out. So yes, I think it opens the door to consolidation, but I don't think it's related to interest rates. I think, and Chris said this really appropriately, it's about the balance sheet. If you've got a good company, you've got good management, you've got a good product, that's not going to guarantee you success, but I'm much happier to put my capital and bet on you over someone who, you look at the Rivians where their valuations went completely off the charts before they had product and before they had sales. And those things have now all come back down. You look at the Zooms of the world and others, the valuations are now a lot more reasonable. So I think we care less about the interest rates, but what's the opportunity for the company? How does their balance sheet look? Do they have the right guys in the right seats? And do they have the potential to take market share? If that's the case, again, VCs, private equity have had, and there is so much cash in the sidelines. So getting access to that, I only care about interest rates if I'm going to lever that up. So you know what? I'll lever it a bit less, maybe have more moderate returns, reduce them a little bit because I borrow less, because there's just so much cash out there. And we're talking about cash on balance sheets from 2007. This is not new. So we need to tap into it. So I'm less concerned about interest rates. I'm more concerned about quality.
Sammy, I have a question for you, if you don't mind. Mark Kyle. You mentioned Zoom there and coming down, and let's assume there's some layoffs and they're trimming the fat off the company since they raised so much money in the last round. And you have the choice between Zoom or Zoom 2. And Zoom 2 has a great growth pattern to it. But again, it's a younger company, a newer company. Which one are you more likely to look at and give real credence to?
I love you, Mark, and I don't love you.
First.
Because that's such a complex question, because it's not that binary and simple. It's a lot more complicated. And again, you got to look at what are the differentiation between the two products? Do they have the right people? How are they getting to market? Can they take market share? I mean, it's like looking at a Netflix and a Hulu, right? Netflix was the old guy in the street, and Hulu came along and started taking market share because it offered better product. So again, if you've got the right people at the table, you've got the right offering, I think people who are kind of lazy and sitting back in the armchair are going to lose market share. If you can be more nimble, if you can be better on your balance sheet, me as an investor, I'm going to look for that. I want to see my upside. I want to see what my potential IRR is. So you've very much simplified something. I think it's a little bit more complicated. I don't know what Eveline and Chris think, but it's really difficult. Again, if it's based on IRR, the younger one may look easy, more interesting. But again, how's their balance sheet? How's their management?
That's a good point, Sam. I think what would be nice to ask Chris and Evan what their thoughts are based on the same question.
Evan?
Well, I think it depends on the stage of the company. Like really early stage companies, they don't even have a balance sheet, right? So there, it's like Russell was saying, you just put a little money in those companies and it's a bet. So that's like really pre-seed and some of the seed stage. As they go, bigger and they go in different stages, they have first round and maybe they are doing a round A and B. Then they have a business going on really, and they have a balance sheet. But there, I would really look into the revenues and the cash generation. So, and the job of the fund management, thank God I'm just like doing, bringing the deal and trying to exit and not being like an active fund manager anymore. But when I was, the value creation process, you had to be like calling this company sometimes not only every week, but almost every day to coach and help the CEOs. You have those young CEOs. That's why sometimes you have older CEOs that have experience. Those are better. But still, they need some guidance and some coaching. So as you need to be really close to the companies as a fund manager to see how they're developing. And for them to keep the eye on the ball of like, you're growing, don't get in debt, don't save the money. That's the difficulty thing. That's why I have so many consultants helping those companies now. So the difference that now you cannot go and keep like borrowing money. You need to do rounds. And when you do your round, you need to, be very disciplined with the cash that you have in hands. And that's the tricky question is, did you invest in the company that can really grow organically, and those companies take time to grow. But I think that if they show that they are growing within these tough environments, and they don't need to, early stage companies, they don't need to go into venture debt, and some of them, I would not advise that, but this market is there. They can really grow substantially, primarily in the technology area. I know AI is everywhere, but you look companies primarily in the healthcare space and food related to health as well. Those companies are doing really well. So one of the funds that I'm on the board, we invest in companies that are like food that's health related. The other one is invested, this one is like a supply chain to finance for small companies that trade in Amazon. And then we invest in companies like SpaceX. So who do you know when you invest in SpaceX that you really like would grow so quickly? But again, then you look at the management, look how they were able to, deal with the government. So again, as you said, Samy, each company is a company and each stage is a stage. But I disagree with Marty when he says it's going to be a tough year for venture capital. If the funds exit, they will be able to raise more capital.
If they exit well.
Well, some exit. You need to some exit. I mean, look, instead of like for instance, 2 exits that we just did an exit now for one of the funds was 7x in 7 years.
7x, 7 years.
Yeah, so it's not bad.
Yeah, so here's another calculus I'm gonna throw at you. Silicon Valley Bank was out there, and so when they were going under, I was over at Wilson and Samy's offices, and they said, this is really bad, we're in partner meetings every night. And the big deal is that if you were a deal that raised $20 million, it was automatic that you would get $6 to $8 million from Silicon Valley Bank, just right away. It was just an automatic thing. If Andreessen Horowitz invested in you, boom, Silicon Valley Bank invested in you also, right? So that's gone. That's no more, it's not that automatic revolver anymore. For
Yeah,
you.
that did more damage.
There's a huge
That did more
void.
damage, exactly.
There-
right.
there's-
So
It's got the
SVB is a
discipline,
huge
right?
So to me, there's less runway.
I mean, look, Signature Bank and like sort of like that low end real estate here in New York is a big hit. And then
Now the other problem with funds raising new capital, and this hits Taylor, is that because the valuations have not reset on a lot of companies and portfolios, the fund consultants are saying, hey, you have too much money. If you're an LP, you've got too much money allocated into these funds, right? Because there was a correction in the public markets, but it hasn't happened in the private markets. Valuations are still high. So they're saying, you know what, you're already over allocated to PE or VC. Don't invest in this segment this year coming up. That's, I mean, Chris, you're on that side. That's real.
I think that I think from a family office perspective, like I said earlier, I think.
Or endowment foundation.
Yeah, I think they're all looking at the illiquidity as an issue, right? And to not allocate more capital in the short term. And everybody we all have to grapple because it's such a unique thing in the English language that we say what's new all the time, what's new. If you go to other languages and cultures, they don't say what's new all the time. Like we are always what's new. And that is, it's kind of a genius.
I like that.
It's kind of a genius sort of nuance where we don't really remember what's going on. We do have like 2 wars going on. We're spending $1 trillion a quarter. I mean, like there's a complete, pardon my French, shit show going on out there, and nobody seems to realize if these are talking about like a 10x on, like I said, some canned, tequila beverage, right? And it's kind of like, are you kidding me? So I think there's a lot of things to digest. And to the earlier question, we have to remember that IBM got 50 years out of the mainframe, if not longer, right? How long did Apple get a monopoly on the iPhone, right? Now, if you've come up with the next greatest thing, what do you got, 18 months, right? And so these companies, to the point of financing and having access to capital and all, they constantly have to be thinking because the cycles get so short now, right? And a kid said something to me once, this 30-year-old broke up with his 25-year-old girlfriend because there was a generation gap. And I said, so what does that mean? I go, my father-in-law is 20 years older. We know the same movies and books and this and that. And he goes, no. She doesn't know what Angry Birds was, man. You know, like, and if you think that the world moves so fast, like nobody knows what's going on. So there's just a lot of trends that we have to pay attention to.
This is, I think, one of the best times for investment, in my view. Why do I say that? If you look at the valuation healthcare that I know a fair amount about, there is a lot of valuation difference. The volatility is huge. Some things are valued hugely and some things are just done. Now, a lot of P&L companies that have got great products and they've got the cash flow, they got the whole thing being valued for nothing. You look at HCA, it's valued for 0.4 times sales. It's ridiculous. And then there's some that are valued 10 times sales, 15 times. So I think that the merger of some of these companies that have the P&L responsible look and feel, get the market capability with the technology companies that we've had in our portfolios. That is a fantastic area. I've seen this play before. So that's an area that I would focus. You can just suddenly lift them. Example, I did a matrix of these companies. I can show you the really low value, very good P&L for a long time history. Then I could show you the new ones that are coming in. And the most important ones are the ones that merged those two concepts. They've been picked up. CVS picked up two companies, each worth $9-10 billion. And Amazon picked up another one for $4.5 billion. But then yet there's companies that, in that group, I'm happy to share that.
How old were they?
They were like, one was 8 years old. One was longer than that, about 10 or 15. But there is a need in the market. And if you bring these two things together, this is the time to exploit it. I'm doing it. And it works. So I just was offering a solution that I think it's one of the best times. You really can pick up great stuff, mix the two together, and have a really responsible, P&L responsible company. I had to really suffer through that. I just recently did it, and it's in the middle of doing it. So it's really very interesting times to really look at it. I saw this in the 90s. I saw it in the 80s.
Oh, interesting.
That may be it.
Interesting. We want to go to Taylor and to Samy with regards to the M&A landscape of what you think the M&A landscape looks like for next year. Obviously, we're talking with regards to the economic situation, political situation, but still M&A, your observation on where this kind of stands in the private equity venture capital, or just in general, some thoughts around that. We'll take Samy first and then, yeah.
Okay, I was going to let Taylor go first because I've been speaking way too much.
Taylor,
you
want Taylor to have an observation?
Go ahead.
Samy, go ahead. We're going to get to Taylor next.
All right. So I agree with the comment just made. I think there's some great opportunities in the market for consolidation because companies are struggling to find money. So if you can put, a couple of companies together, the sum of the parts is worth more than, like, why the heck not? So I do agree. And like I said before, I do think this is a great opportunity to invest. I think valuations have come down dramatically. That bubble has been deflated. We've seen massive drops in valuations, especially in tech. So I'm a big believer that we've got great things ahead. If I'm going to play in VC and PE world, I want to go for more the boutique firms than the big players. I don't like the big players. I think growing up in England, we had this saying that the smaller ones are more juicy. It was a Tangerine advert. And I really do believe that the smaller ones are more juicy. So I prefer to go for the smaller funds than the big, gargantuan funds that try to do LBO and MBO. So again, I'm not concerned about interest rates. I'm not concerned about the presidential elections because business has to happen regardless of who goes in office. And a lot of what's going to happen at the top of the house is not going to be VC and PE. You've got to get your business moving. You've got to keep going no matter what. So I think those are noise rather than direction, in my humble opinion. I think one has to be careful that all the AI stuff doesn't become the new bubble, like we've seen in the past with EVs. EVs were like totally overdone. The whole, blank check investing again, the specs, as we now call them. Same thing. It overinflated the market on valuations that were unreasonable. So focus on boutique players that aren't squeezed to go into investments they don't have to, where they can be selective. Careful on direct investments, because if you don't have the wherewithal in your family office, you will get into things you either don't understand or you're overly exposed to anyway, and you're not getting diversification. But I think there's great things for 2024, 2025. I think anyone investing in those vintages are going to be very happy come 5-6 years time.
Thank you, Samy. Taylor, what your observation as far as that same question about the M&A for 2024 and the impact that it may have on valuations and so forth, and what you're seeing and what your thoughts are?
Yeah, and I agree with Samy, and just jumping off of that, now when valuations are still recovering, I think, it's still, there's still fewer good companies than there are buyers or investors. And so it's still in a way it's still a seller's market, and it has been for years. And so to the extent you find good quality companies with the current kind of decrease in multiples, now it seems like not a bad time to be investing. Same thoughts as Samy on that. But we, as we talked earlier, we do expect transaction activity to continue to recover this year. And we'll see if the valuations follow that. But generally it seems like, it's a good time to kind of take advantage.
Yeah. Thank you. Taylor, you had another observation with regards to the energy sector. I think that's a question that I know that we had discussed, and how the impact it had on private equity. Sure.
Yeah. I mean, I sit here in Houston, so a lot of what we do is energy related. And as a lot of you know, we saw several, we'll call them downturns over the past 10, 15 years, right? We had the 08, 09 downturn. Then we had the crash of oil prices in late 2014. And then we had the COVID, issue in early 2020. And the industry, it never fully recovered even after the 2014 crash. And then we experienced COVID. So over that whole time frame, there was a lot of pressure because of underperforming financially. And at the same time, they had some, social headwinds, right? With, pressure toward ESG and things like that. So during that time frame and over the last few years, we've seen a big kind of transition in the industry to focus more on ESG and focus more on living within cash flow, where everybody is now focused on, generating cash flow and distributing cash flow, as opposed to just growing resources and investing everything back in and never distributing anything to the owners. And with that transition, you saw executive kind of pay structures tailored around, around that, as well as, the implementation of ESG. And we're seeing, your traditional energy companies making big investments in the energy transition. Every energy conference you go to, that's a very high topic. Although what we're hearing is that, the investment opportunities in that space are still, you might look at 100 deals to find one good one, compared to maybe 10 to 1 or 5 to 1 on a traditional company. But there's a big effort toward investing in ESG and generating cash flow. And with that kind of transition, and with the recovery in oil prices over the last couple of years, and kind of relative stability in oil prices over the past year or two, the companies have been performing well. IRRs are very high in the space, and we've started to see private equity kind of start to move back into the space after having, taken a few years off, so to speak. So we're hopeful that trend will continue. We're seeing, preparation for more activity going into this year. We actually saw 2 upstream oil and gas MLPs go public this year. If you can imagine that. I mean, it's been many years since we saw that happen. So we're seeing some signs of health and life back in the industry, and we're hoping that will continue.
Yeah, thank you.
Yeah, I have a
Anything else?
comment about two things that you both said. The first comment is about valuations. And then 2 years ago, I was speaking a panel, and I had like an insurance company, I had a pension fund, and venture capital and private equity were doing really well. And they were all like CIOs, and then we were preparing and we're talking about it and said, listen, I would love to put more money in private equity and venture capital, but when you look at my portfolio, the public markets valuation is so bad that I am overweighting in the direct investment. So I need to wait until public markets come back. So what's happening now is that public markets are coming back, and as the venture capital companies are trying to exit, you're going to have more IPOs, like you just mentioned. And I think, and then I go into your comment that politics doesn't play. So I think the feeling that I have is that most of the family offices and LPs are going to be looking at those exits, like through IPOs and other things, as the public markets evolve. I think they're making some good money in the interest rates the way they are right now. And I think that if I were a family office, and I would wait until the elections to really make a decision, because when you put money in a fund, it takes 10 years for a company to grow, right? So it's really a 10-year commitment. And depending on the administration, and again, it's not a political statement here, but I think that if this administration continues, it's like a continuation, right? And interest rates are going down, price of gas going down, we have a problem at the border, we have the war, but everything's kind of floating, and you know what's going on, right? But if you have a change in administration and you come with somebody that tweets every morning, I'm going to do this, I'm going to do that, you're going to have like 4 or 5 years, you don't really know what's going to happen, right? But again, you could have somebody else coming from the Republican Party that could be like somebody stable. So I think that the election, I talk about Nikki Haley, she's a woman, come on, and I think she'll be stable. So yeah, stable, like not tweeting every morning. So I would sit and see what's going to happen with the election, because as he said, has so much stuff going on, and we have no control over what the governments are going to do. So I would sit tight before putting money in a fund now for 10 years, and I could lose 5 years of those 10. I mean, that's my opinion, but
I politely disagree, because business has to continue, life continues regardless of who's in the White House. It may have slight changes maybe to energy in certain sectors, but life doesn't stop because of who goes in the White House. Business has to continue, life has to continue. Again, I think it's a distraction, shouldn't be a focus. You've got to keep investing, otherwise you're going to lose opportunities because you're waiting to see who's in there. We're a year away, and until what, April, we're not really going to know, or March, who's going to win the nomination. So we sit back and do nothing. I think that's a very dangerous strategy, in my personal opinion. Again, businesses have to continue. They have to continue to exist. They have to continue doing, investing in their people, investing in resources, investing in new products. They're not waiting to see, be it, Joe Biden, Nikki Haley, Trump, or whoever. They don't care. They need to survive. They need to invest. They need to grow.
So I think they will go in more liquid investments. That's like public markets, for instance. You can get in and get out. You go to liquid investments.
Well, last year was a good example.
Taylor, can we have a final comment from you, perhaps for 30 seconds?
Sure. Just generally, there's a demographic, the market demographics are such that I think it's something like 80% of wealth is in private companies now that are going to need to transition, right? And either through an exit or transition to the next generation. And at a very high level, that will drive a lot of, exits and activity going into, the next several years. And with that, and with the kind of stabilizing interest rate environment and the fundamental performance of the economy and everything, I think just my high level parting comments are that we're excited to see what 2024 has to bring, and we have high hopes and expectations.
Thank you. Chris, final comment?
I I agree that, all of this stuff is noise. I tend to, like to talk about it, but life will go on, right? Or the show goes on. So the show will go on. I think health tech is going to continue. I currently wear the Aura ring, which I sit here and I say is the flip phone version of health tech. In 10 years, this thing will be like an iPhone. So God only knows the diagnostics that'll come from something like that. So I think anything health tech is probably going to be booming. I think fintech is going to continue along its way. Like we've said before, a couple of sectors may get jammed up with the election cycle, but everybody will figure it out. One of the other trends that's moving is the trend towards co-invest. There's a lot of co-invest opportunities. I know somebody who raised $75 million for their fund that they were trying to get 150. They ended up doing 500 million in co-invest on the side. So why do people want to do that? Is because co-invest may have a return in less than the 7 to 10 years that you normally get. So I think that co-invest will be a continuation of trend. I mean, look, money's got to move. And that's what I was saying. Like when you're IBM for 50 years, you can slog along selling mainframe computers. Money's got to be a lot quicker and a lot more adept these days because things move, right? We invested in some robotics company that was fantastic, has like this cyborg, 5'4" cyborg, moving boxes around like this, makeshift Amazon warehouse. And then this morning I wake up on LinkedIn and Tesla's got one. Well, almost looks just like our guy, right? So you sit there and you're like, great, so it's going to be an arms race in that. So here you thought you had like, this range of motion that was kind of like game changing. Now all of a sudden that one has kind of a bit of it there. So I think it's all like, as we're all Americans, right? We're bullish. So I think we'll all figure it out along the way.
Everyone, just 30 seconds.
I thought I was done with the politics. I did a political comment. No, I think that public markets are going to do well. If I were, again, okay, I like the SPV idea because it's, that's a good way for the funds to, finance the companies.
Yeah.
That's a good thing, depending on the cost as well. That's a good, I'm not saying it's not a good time to invest in a venture capital fund. I'm just saying that I think that a lot of those LPs are going to be playing a lot of public markets this year because, some of those, like, if you're like one of the funds I'm on the board, it's a long equity fund, like very concentrated. And this guy, he has been doing 30, I don't ask me why, but he has been doing like even the Dow market, 30% a year. And this year he's doing 50%. If you invest only in the S&P 500, you're going to be doing what, 20% this year. So I just see like in this, the mentality of like capital preservation of some of those families have in mind to be more like stable, like I talk about like, revenue generation, like, fixed income markets and public markets that they can get out very quickly. But some are not like that. Some would like just go and make investments and forget about it. We have 15 years, I can sit there forever. So it really depends, as you said, depends from one family office to another, right?
Thank you. Thank you very much for your feedback.